Welcome to the Traders Desk. We're on the 20th of July 2025. Everything that we discuss here is not financial advice. It's purely for educational basis. Do read the disclaimer and also do read the copyright notice. Another, let's call it boring week in financial markets. Not much happening. The S&P had a little bit of trouble to make a new high. It had a little bit of a mixed week, if you ask me. But also that's a function of lower trading volumes, given that people in North America and in the West in general tend to go on holidays around this time. What I've got on the right is an interesting chart. This is the S&P 500 denominated in euros. So we all see these charts of the S&P 500 making new highs and, all of that. But if you look at the S&P 500 denominated in euros, it's a totally different story, right? So that definitely gives you an idea of how much the dollar has depreciated since, let's call it March, April, when we had the sell-off in financial markets. That's a big signal. It's giving you a big hint in terms of how much capital left the US at that point. And, around that time, people realized that there is a big opportunity outside of the US within European stocks, emerging markets, and all. And a lot of money has gone to these types of situations where people think they'll get a better return on their investments. But nonetheless, right, if we head back to the US, the markets have been extremely strong, done really well in dollar terms. And now in euro terms, what we're seeing is that the S&P 500 is finally breaking above the 200-day moving average. So this is a chart I haven't seen at all on social media. I mean, for all the nonsense people talk on social media, for all, the intellectual curiosity and, all the geniuses out there, I would have expected someone to actually, think about the world in these terms. But yeah, it's very hard to find anything like that. Anyway, that's here just for perspective. You can think about it, assign some meaning to it, or just ditch it as you please. Moving on, so if we look at the equal weighted version of the S&P 500, the RSP, it's definitely heading towards a higher high. Um, Actually, it's been kind of stalling, and there's been a little bit of sideways move. Um, but I think the it's probably gonna go higher as we see that this rally broadens out. Um, I think this is a sign of a healthy economy when you see the rally in stock markets, not just limited to the top 10 companies, but also widen across different industries, industrials, retail, financials, real estate, and so on. Um, so this is an index that we need to keep an eye on, because if it heads back down, let's say to the 200-day moving average, I think that would be totally contrary to the whole thesis around the rally broadening out. And as we can see on the right, the Magnificent Seven keeps making a new high, so it's recovering. It's not yet gotten to the previous highs, but it's very close, and I think it probably will get to its previous highs. So this is giving you an idea of how quickly the Magnificent Seven has been recovering. A large part being because of great fundamentals, except for companies like Tesla and Apple. I think the rest are doing really well. Um, I cannot wait for the day when Apple it gets kicked out of the Magnificent Seven, but that's just me. It's my personal thing against Apple. Um, but yeah, if we get back to objectivity, I think this is how we need to be looking at the financial markets. It's still being driven by the Magnificent Seven, while if we look at the breadth of the equity markets, it's been widening now, not necessarily widening further. We just need to keep an eye on this because that will inform where we deploy capital to, right? I've also got the IWM, which is basically the Russell 2000. So this is the small cap index for US stocks. As you can see, it's been having a lot more difficulty in the recovery, but it's finally broken above the 200-day moving average. It's now kind of moving sideways, not able to make a new high conclusively. So people still need a lot of conviction to be able to push this higher. Um, a large part of the rally in the small caps is also down to short covering. And this is where the lack of conviction is coming from, right? Because a lot of these stocks, they move 20, 30% up just because people are getting squeezed out of their short position. And it's not because you've got fundamental buyers necessarily that are driving the prices higher. So as these prices go higher, the indices also go higher, but then there's no one to take it further, right? To take it much higher because you need fundamental buyers who see a better prospect for these companies 6, 12 months down the lane to be buying these companies, accumulating them, and then making these newer highs. I'm not saying we cannot get there, but all I'm saying is we're not there yet. And when this starts breaking out properly, that would be a confirmation that the breadth in the financial markets or in the stock market is definitely improving. Um, I what I also will say is there are fantastic opportunities within the small and mid cap segment of the market. So if you're doing your research, make sure that you're focused on that side of the market too. On the right, I've got the momentum ETF. So as you can see, this has been driving the recovery of stock markets. So this is comprised of stocks that are highly momentum driven. So in other words, a lot of stocks that are held by retail and people who don't necessarily do a lot of fundamental work and just chase moves. Um, but nonetheless, that's momentum has been on the way up. We have to acknowledge it. We have to respect it. Um, but it's also there for perspective, right? For us to understand what underpins this rally or this recovery in the financial markets. Because if going forward, right, the fundamentals are going to be weakening, as we've seen last week, right, the expectations across the board for the S&P 500 earnings or EPS uh, for calendar year 2025 keeps going lower. So the estimates keep going lower, but the stock price itself of the index keeps going higher. In other words, the multiple keeps expanding without necessarily us seeing improvement in the EPS. Um, is that a short signal? Not necessarily, but it does give us a very good indication of how vulnerable this recovery could be, right? Because essentially what we've seen is that price has moved well ahead of fundamentals. And now I think there will come a point where the market will be like, is fundamentals going to pull along, or has price extended for too much and then it will probably recover just to kind of get back into equilibrium. So that's kind of the dance that's always happening in financial markets, right? People get excited, they give a lot of benefit of doubt, they ignore a lot of the risks, and then they climb over the wall of worry. Once they're there, then the market stops rallying, they go sideways, and then everyone starts looking at each other and start doubting whether this move has strong legs to go higher. And that's basically where people take profits or start shorting stocks and everything. And that's what causes a bit of vulnerability to the rally. But nonetheless, let's not forget we are in a roaring bull market, right? um, there are very strong fundamental factors that underpins this stock market rally. It's not necessarily in terms of corporate profitability yet. A lot of it is driven by policies that come through the one big beautiful bill. Um, a lot of it is in terms of increasing the spending power of consumers, and that's getting priced in ahead of time within the stock market, right? So it remains to be seen whether actually what the stock market is predicting is going to be seen in corporate profitability. That's basically how things are at the moment. You've also got the other side of the coin, whereby there's a lot of narratives that the Fed will start cutting. They're not there yet, in my view, but at some point they will. And the market is kind of looking beyond maybe the next couple of meetings where the Fed doesn't cut, but then eventually they will start cutting. That's what the market is setting up for. And it's already moved well ahead of, the Fed even announcing a cut, right? So the question we have to ask ourselves is how much longer till the market kind of says, oh, by the way, we had all these assumptions and maybe we're slightly wrong on these, and it starts pulling back a little bit. We can never time these things, but we always need to understand what forms the legs of this rally and what are the pillars that could be a little bit vulnerable, and spot them in advance as the hard data is coming through, and then realize that a lot of people will soon figure out that they are wrongly positioned. And we always run a long short portfolio, so we're not here trying to call the tops in financial market. I always maintain, even in a roaring bull market, you need to have your shorts in the book, right? And if you notice in the Discord server, there's been little discussion about long trade ideas. I'm sure anyone can find a long trade idea in a roaring bull market. It's not difficult. What's difficult is to find short trade ideas in a roaring bull market. And I've just discussed previously, right, in terms of how we find these ideas and how we find pockets of the market where, it's ripe to start looking for short trade ideas. So as a trader, this needs to be in your toolkit, because you cannot tie your destiny to the direction of the market and just, if the market is rallying, you play the long game, and then when it starts falling, you play the short game. That's not how it works. You have to be willing to play both games at the same time, because even in a roaring bull market, you'll have meaningful corrections. And when you have these 10-15% correction, that's when your shorts will pay off quite handsomely. It's not to say that even in a roaring bull market, our shorts cannot pay off. That's literally the skill that we develop in terms of finding high quality shorts that even work, even if the market is having an amazing day. And I think we'll see one next week, one or two next week. Um, and, to me, it's beautiful, right? Because when you guys see this, you like all of these conceptual talks become a lot more rooted in reality. The belief system changes, and then you realize, actually, yeah, this makes sense. And it's not like we have to go to Mars to be able to find these ideas. There is a process, there is a way to find these ideas and structure them in your portfolio. So, in any type of market environment, you still have the odds stacked in your favor. Moving on, the long-term yields. This is something you need to keep your eye on. The US 10-year, it's been coming down in the last few days, but it's still quite elevated, right? So I think on the week, it's probably flat or maybe slightly up, but it's currently at 4.42. So the housing market and any sector that requires long-term yields to be lower is having a little bit of difficulty. And what's been quite intriguing is that a lot of the long duration assets have kept rallying, even if the long-term yields have not necessarily pulled back. So that to me indicates that the market is getting a little bit complacent and probably being driven by short-term covering, short covering, right? Um, and we're heading into an earnings season, right? So you would all remember ideas like Asana, for instance, right? Where the stock was trading around, I don't know, $18, $19, right? and the US 10-year yields were well above 4%. And meanwhile, the fundamentals were also weakening. So before earnings, we realized that there is a situation here where if we get further deterioration in the fundamentals, the market will reassess the estimates for this company, and there is meaningful downside. So this is the setup here now, right? We This is exactly the same setup. Uh, of course, you're going to have a lot of long tech ideas. That's what's working at the moment. But you'd be stupid to not have one or two short tech ideas too, or short, long duration assets. So if you can find asana type of ideas whereby it keeps grinding higher even if the fundamentals are not necessarily improving, and rather you see that there is potential for further deterioration in the fundamentals, and meanwhile you have this big you know uh, big macro headwind, which is the long-term yields that are pushing that's going to be pushing on the stock once the new fundamentals are out and people realize that there is no need to be buying this stock because it's going much lower. So that's how you need to be thinking about the stock market at the moment. Um Looking at where a lot of these long duration assets trade at the moment, while we have a big macro headwind, uh, and many of these stocks do have fundamental weakness. It's for you to go figure out which one to play. We'll also have the Fed meeting, I think, towards the end of July. So I think that's probably, yeah, within a few days. Um, so the market has probably come to terms to realize that there's not going to be any cuts in July, right? Even if, let's say, 2 weeks ago, they thought the probability of a cut in July would be 25% and above. Now it's almost down to zero. So I don't think the Fed meeting is going to influence anything unless if Powell makes some dovish comments. Um, we'll see. We'll see what comes out of it. But keep your eyes peeled. That's the way to win, right? Identify this price dislocation or this very short-term price dislocation of certain assets that have no business trading where they're currently trading at. And then going into earnings, investors get a proper reckoning and a reality check. And then there's meaningful downside in these stocks. I'm going to pause here and just open the floor for any questions. Do people understand exactly what I mean by, finding these opportunities? Anyone? Okay. Looks like you probably have a very good idea of what I'm trying to imply here. I think if you're ever in doubt, Asana is a very good blueprint. You can go in the Discord server and just try to follow the same systematic process. Of course, it's not going to be exactly the same. Just bear that in mind. But look at the principles. I put out a video yesterday, last night, right, saying people should learn principles as opposed to tactics because principles are timeless, whereas tactics are, they're short-lived, right? So if you figure out the principles, you figure out what the right tactics would be under a specific set of conditions. So it applies here as well. What we've done in Asana, it outlines the principles as well as the tactics. The tactics might change slightly depending on which company you're looking at, but the principles will probably still stand true. So you've got the blueprint there. Just go figure out, think about it, do your work. A couple of hours can give you a very, very good idea. Moving on, this is something that I don't think we've discussed before, but this is one way to figure out, what's also driving the rally. What I've got here is a list of companies mid cap and above with high short float interest only in the US. So if you look at the performance monthly, right, you can see like a lot of these stocks are in the green. So we're not being unreasonable when we're saying that a large part of the rally has been driven by short covering, right? So if we were to form a basket of high short interest stocks and then maybe make that into an ETF, we would have seen that this ETF has been making new highs. And actually, I've been thinking about, what's a better way of illustrating this or keeping track of these things. What we could do is to create a little bit of a, we could create a portfolio of these highly shorted stocks and then keep monitoring. So we turn that portfolio into an index and then we keep monitoring the movement of that index. You could do this for shorted stocks. You could do it for stocks within an industry if you want to keep track of what's happening to, a basket of stocks. For instance, for AI, this is something that I've done. So you know how we've segmented the AI stocks into broadly three categories, right? So what I've got is basically three different baskets amongst these three different categories, which I'm not going to name now for obvious reason because this is on YouTube. And then I keep tracking, how these different baskets are performing. And the advantage of doing this is it allows you to understand when the market has moved from one category to the other. So, for instance, is the market still focusing on GPUs and giving credit to more and more and more GPUs being bought and deployed? Or has the market shifted its view towards, let's call it some of the software that are now leveraging AI to be able to redefine their business, gain market share, and improve the asset quality altogether. So having these things well prepared in advance give you a very good visual representation of what's going on in the market. Okay, let's move to this week's sector performances. So, not a surprise, tech had a stellar week, another stellar week. So, if you look on a monthly basis, tech is one of the biggest outperformers by far, right? And tech is comprised of a lot of long duration assets. So, think about it. If you're able to find a short within the segment that's performing the best in the market, that's true skill. It's exactly what we did for Asana. In the middle of a massive tech rally, we were able to find one great quality short idea. And this is really the sign of good stock picking or good trade idea generation, right? If you're able to do this in a market where indiscriminately it's just rallying, because something is a tech company, that's a sign of you understanding exactly how the market looks at these things, understanding of catalyst, macro headwinds, um, you know, upside and downside potential within a particular situation. Quite interestingly, utilities were the second best performing sector. I think this is a large part driven by AI. So don't look at this as a defensive move. It's, by and large, this has been a risk on move in markets. And then in terms of underperformers, energy and healthcare were the laggards as they've been for many weeks. Um, Energy, of course, is related to the oil and natural gas price, which have been coming down a little bit. Healthcare, I think you would have read the thesis on Oscar Health. I think I've provided my review sometime midweek. Within that document, there is a lot of discussion of the regulation or the regulatory changes within healthcare. So if you pay attention, there are many ideas that you can generate from there. Although you might be a little bit late now, but you would remember me talking about this sometime in November, December when Trump got elected. right? The whole story around Obamacare being repealed and all of this, it's actually now been voted. So a lot of companies that were reliant on, on revenue from Obamacare and all these the healthcare regulations, um, like Affordable Care Act and so on. So there were many companies that had their business model overly reliant on, these acts. They're getting found out. I can name a few: Elevance Health, uh, ELV, Centene, CNC. There's a couple more. If you pull up their charts, right? Actually, let's do it now. Uh, it's not a great look, right? So if you had done your work, right, you would know that, these are companies that have significant downside, right? So around December, you could see the market was already positioning for that. And then somehow it rallied, hopeism in the market. Then, it's giving you a great opportunity to participate again. And now it's like down quite significantly. This is a much cleaner idea. Centene, look at this one. So in December, we were somewhere here, right? Somewhere here. 65, let's call it 65. It's now trading at 27.95. And at this point, you would be like, yeah, but doesn't the market already know this? Hasn't the market already priced this? Or, yeah, Trump will not do that. It's too drastic. It's too extreme for these companies. Guess what? This company was trading at 65 and now it's trading at 28 and it's going to go much lower. Um, so, whenever we have this discussion about, yeah, the market has already priced it and so on, just remember, right? Um, these situations also exist, right? Because um, if you always fall victim to this dance whereby you find a situation and then you're like, oh no, maybe I'm too early because the stock hasn't moved yet, then you don't participate, right? Then you have the other situation where the stock has already moved and then you're like, yeah, but maybe it's already priced in and it will not move further. Again, you don't participate, right? In neither of these situations, you're giving yourself a chance to even win, right? So when you think about this, what's driving the way you're looking at these situations is just fear, right? It's fear. It's probably you wanting to be a perfectionist and wanting to find the perfect trade that somehow you figured it out. The market hasn't yet figured it out. And you want certainty that the stock is going to move based on what you've discovered on the fundamental front. That's not how the stock market works, right? Stock market doesn't really know you personally and doesn't really work for you, right? So that's something that, a lot of times it comes across, right? Uh, there were a couple of ideas that we discussed late last year, whereby, the group was struggling with this psychological barrier, right? Hasn't Is this not already priced in and all of this? And then what happens over the next few weeks? The stock moved 20-30% down, and then we're like, was this priced in? Right? So be very wary of that. It's good to ask the question, is this not already priced in? Am I just looking at data that the market has already looked at 6 months ago and priced it in and figured it out? Or is this an actionable catalyst within the next few weeks? It's a very good question to ask, but just be careful not to be using this as an excuse for not taking action, right? I'm sure this resonates with many of you. Okay, let's move back to sector performances. So I quite like consumer discretionary. So it's been an underperformer, but it's kind of under the radar a little bit. On a monthly basis, it's probably the third best performing sector. This week, a little bit tepid. as we head into earnings, I think there are many companies within where, we can have significant upside. We've discussed this quite a lot in the last session. So uh, just make sure that you focus on these pockets where there are great opportunities in the market. So moving on, in terms of industry performances, another stellar week for clean energy. You would have thought that the regulatory barriers or regulatory headwinds would actually be negative for clean energy. Somehow it just keeps ripping. Um, I suspect a large part of that is short covering driven, but it's not a sector I've been following very. It's not an industry I've been following very closely, although we've discussed a couple of ideas. You know, um, Nonetheless, this industry is up 24% on the month, and then over the week it was up 9.4%. So definitely something to pay attention to, right? And if we were to look at its peer in terms of solar, uh, a bit of a mixed picture on the weekly basis, but on a monthly basis, still a very, very strong performer. Actually, the second best performing industry on a monthly basis. So there's definitely a story going on there, right? Um, Anything I'd like to discuss? Metals and mining, yeah, a relatively good week. I think a large part of this is driven by the tariffs that are being imposed on steel, aluminum, and copper. So the local producers are getting a bit of attention, right? If we go back to the underperformers, the gold miners, another week of underperforming. It's down now 3.5% on the month. So I'm just going to call Bhavan now. So, Bhavan, um, you remember our discussion maybe 3, 4 weeks ago, right? In terms of shorting gold miners as a pain trade, it's working out beautifully.
Yes.
Yep. Um, I was looking at GFI a few hours ago. It's had a bit of a rally on the week, so it's back to above 24. But this company looks quite vulnerable to me. So if you're still looking, at pain trade, I think this could be one of them, especially as we get into the Fed meeting and maybe the Fed indicates that it's not dovish and it's seeing a lot of inflationary risks. Now you would say to me, okay, why would that matter? The gold price goes up as the Fed starts cutting interest rates. So the gold price is highly correlated to the real interest rate, or actually negatively correlated to real interest rate. So if real interest rate is positive uh, and going up, that's a that's a negative for the gold price because gold doesn't yield an interest. It doesn't yield dividend or it doesn't give you any form of interest, right? When you hold it. So when you think about it, if you were given a choice between an asset that gives you a real interest rate and the choice of holding gold, which gives you no interest rate, but gives you protection in terms of if the financial system collapses, if there's war and all of that, right? So that's how the market perceives gold. Of course, a lot of central banks have been buying gold and driving the prices much higher. There's also been heightened geopolitical risks that have taken the gold price significantly higher. But the question now is gold going to go even higher for these miners to keep heading higher? That's the question, right? And I think I still see an opportunity here being short some of these gold miners, mainly as a pain trade where you get a lot of the retail investors or traders that go into these stocks thinking, yeah, gold cannot go down, and then gold just starts trading sideways and maybe has a couple of weeks of selling off. So, if gold sells off by 30, 50, $100, it doesn't mean that the uptrend in gold is up, right? But if that happens, the gold miners will sell off a lot more because there are a lot of retail traders who don't have conviction on their thesis, who crowd these trades. And then the moment there's a little bit of trouble, they just all abandon ship. Um, let's move on to oil services. I think this is getting quite interesting, right? As the oil price pulls back a little bit. So 7% on the week is a massive move, right? Um, all of these trades are lying there in plain sight. And then you've got home builders. Home builders are up 8% on the month, but down 3.7% on the week, right? And we've discussed it adequately, sorry, in the Discord server. You know my view on home builders, on housing sector altogether. Um, Now it's for you to figure out what do you do with all this information and how do you play it out. There's nothing else I'd like to discuss on the industry front. I mean, there's quite a few pockets of opportunity, both for long and short. But yeah, I think we've discussed this quite elaborately, and there's no need to spend more time on this. Moving on, so in terms of factor analysis, so what's been driving the market is mainly small cap and large cap growth. The rest of the market has been kind of correcting. A big drop in small cap value. So on the month, we still have large cap growth that's been the outperformer. And then that's followed by small cap call and small cap value. So what we see is the market is kind of in between. Does it chase growth or does it look for the security of maybe the lower PE companies? Uh, Also, as valuations get stretched, right? I think a lot of people want to make sure that their portfolios are soundly underwritten and they start reducing exposures to growth high PE stocks and start moving a little bit more towards the value segment. At least that's what I think will happen over the next few weeks or months. Um, and it's not to say that the rally in markets will stop. It's just, people rotating and trying to find better opportunities across different segments. So for now, we also have to acknowledge that large cap growth is attracting a lot of inflows. Um, that's predominantly, I would suspect, because of the tech companies. Tech has been doing phenomenally well, and it makes sense that large cap growth also, gets pulled with this whole move. But I think we also need to start looking a little bit ahead. Now that we've discussed, the recovery, the rally, what underpins it, the yield curve on the long-term basis. I think when we put all of that into perspective, it's not very difficult for us to try to map out what could happen in the future and try to find opportunities within, these types of segments. Um, I think we'll discuss it a little bit in the second half of the presentation, which is just for Discord server members. But yeah, that's probably all I have to say for this for now. And then finally, the corporate bond spreads. So another week of, corporate bonds not saying anything in terms of risk in the US corporate markets. So the spreads have kind of been collapsing, which is a good sign for equities, right? Because it means that the corporate bond market is open and not really worried about the economy collapsing or bankruptcy, liquidity risks, and so on. Um, these things can change on a dime, so we need to keep paying attention to this, right? Don't forget that everything is fine until one day bankruptcy becomes a risk, right? And until one day bankruptcy happens. So that's how we need to understand. That's the nature of risk. It's not something that moves linearly, right? It's more it's almost like you have different seasons, right? You have seasons where people are bullish, everything in the world is going well. And then you have another season where people start getting worried and, you know, keeping an eye on these spreads will give you an indication of what season we're in, and equities will also move a lot according to how people perceive the economic environment ahead of us. Okay, so I'll move on to our segment now.